asking a guy who's long the stock, of course, Judge, it's like asking me if I had a bet on Kansas City last night, if I was rooting for them or if I was betting with my heart. I really think Apple is going to continue to do well. I think the 5G is a game changer. I think that taking out Logitech devices and Sonos devices out of their online store kind of told you a lot about where they think they are, as far as that they think they don't need those peripherals. They think you could still go and buy them at Best Buy or Amazon, but taking them out of their store as they did today, and both those stocks trading down pretty hard, Apple is going to do very well. They're obviously in a different position than virtually everybody else, with the exception possibly of Microsoft, as far as the amount of cash they generate and where they can borrow. So rates are going up. Judge, we saw some big put purchases at the end of September, just September 30th last week, big put purchases in the TLT. Now, they've already made some nice coin on those purchases, and a lot of us think that you could continue to see rates moving up, even though that's contra to what everybody said. They said it'll be lower forever. I do think we will go back to lower, Scott, but I think in the short term, we're going to see a pop out of rates, and that's what that bet in November on those interest rate ETFs told me.
Hey, Josh, how much of the 5G is already in Apple and the move that we saw? I mean, you have to believe that some of the move in the stock building up to this moment was because of 5G, right? Steve Weiss has talked about it all the time on this program, as have many people. What do you think?
Well, I think that many investors are aware of the opportunities that 5G creates, but I'm not sure analysts have done a ton of changes to estimates based on how well they think the next phone will sell. So I would argue that while there's broad awareness of how amazing a 5G future will be for the ecosystem, I'm not sure that that's definitely in the stock. And if it was, then clearly a lot of that enthusiasm has already come out, given the drawdown that Apple is in right now. So I wouldn't use that as a reason to not want to enter a position here.
All right. I want to get back to the conversation we were having. And Steph, as I went to you about this Costin note, which is pretty provocative in terms of what the outcomes of the election could mean for your portfolios, which a lot of people care about, right? We're 4 weeks to the day from Election Day. And you were painting a very rosy scenario for the economy. I don't know if a lot of people agree with you on that, but that's what you're attributing the move higher.
That's the whole point.
That's what you're attributing the move higher in rates to, more than anything else?
Both. It's both. I had said it's coming from both reasons. Better economy and getting more certainty on the elections. And more importantly, it's fiscal. See, because I think fiscal, they got to get it done, because you can't have 14 million people unemployed, right? So they're going to get it done. It's a matter of timing. Is it Pelosi-Mnuchin ahead of the election? Or is it a Biden, if he wins, and it doesn't even have to be a blue wave, you still have an interest in getting some sort of fiscal done. So that is what is these two things. When value and cyclical start to work, it's when you see better growth and inflation starting to go up. And by the way, inflation break-evens, they have resumed their upward charge. They paused on August 31st, along with the market, and now they have resumed higher. That's a very big tell. So I'm not saying we're often going to see rampant inflation and massive growth. We are going to see massive growth in the third quarter, but then it returns to something like 4 or 5%. That's still pretty darn good. And that's good for a sector and sectors that are under-owned, under-loved, which are the cyclical sectors. So,
Rob Sechin, how do we score this out here? You've got the prospects of big spending, a big spending package, if it is a blue wave, as David Costin was talking about, the markets maybe trying to price that in, versus what could be higher taxes, both capital gains and corporate. And then the prospects of fewer buybacks, which would be the result as well of higher taxes, lower earnings, and would that be lower stock prices too?
And more regulation in that environment. I think here's what you have, is you have higher taxes and more regulation taking a back seat to more stimulus right now. In addition, you have the notion that there's likely to be a vaccine or treatment sometime in the intermediate term. I don't want to get too off sides on this notion, though, because let's remember, on November 7th, 2016, the betting markets going into the next day, which was the election day, had Hillary Clinton at 89% chance to win and Donald Trump at 11% chance. So there's certainly a lot of surprise that can happen. I think what the markets have liked is the certainty that comes from the notion of Biden widening his lead. Okay? There's still a lot that can happen with a month to go. And I think we could get back into this contested notion, and that might be disruptive to markets. Okay? And if I'm thinking about how to position portfolios right now, we're overweight global stocks for sure, because the risk trade for the long term is on. But we built some cash, and we built some cash out of the areas that we felt were the most frothy, taking back a little bit of our gains in tech, moving into some industrial exposure with the notion that in the intermediate term, we're going to see this cyclical pickup continue, which we're already seeing in the numbers that Steph talked about.
Yeah.